Hello. Benjamin Graham's The Intelligent Investor holds within it years of experience, trends, and the performance of habits in relation to investing in markets. This video is my summary and interpretation of the book and its topics. I am in no way a financial expert, professional, or financial advisor. The intent of this video is to provide my interpretation of a book and not to provide financial advice. The future for a market is always unwritten, and any predictions are only guesses, which can never be guaranteed. Even experts fail to foresee growing industries. The market cannot be timed. It is impossible. Historical failures of strategists, even from successful managers and publications like the USA Today or the Wall Street Journal, have shown that even dedicated professionals cannot always correctly predict the market. Life is unpredictable, and its unpredictability and countless price influencing variables makes sure no strategy can be guaranteed success. Without guarantee, the next step is to look for likelihoods. We use algebra and statistics to minimize our potential losses. Diversifying a portfolio by buying a mix of stocks and bonds can help dull the extreme fluctuations, both ups and downs, that come with buying fewer or individual securities and putting all of your eggs in one basket. This trades high potential reward for reduced risk of catastrophic loss. It is worth making this trade because losses end up hurting a lot more than gains can help. For every 50% loss you take, you need then 100% gain to recover that loss. In the unpredictable world of investing, the only element you can truly control is your own behavior. Our actions, however, are often shaped by our goals and expectations. Setting unrealistic expectations, such as believing you'll get rich quickly by discovering the next Apple or Bitcoin and selling at its peak within months, can lead to disappointment when reality falls short. This frustration can trigger poor decisions and reckless risks as we attempt to meet these lofty and unattainable desires. So, what does realistic investing look like? A practical goal is to aim for performance that matches or slightly exceeds the market's growth over time. This approach trades short-term dreams for the stability of sustainable, long-term wealth development. While achieving returns that surpass the market is possible, doing so requires significant time, effort, and expertise, essentially treating your portfolio as if it were a full-time business. For those without such time or resources, a defensive and less active strategy can still yield modest and steady returns. Investment outcomes in the short term are heavily influenced by the speculative public, which often chases trends and invests in anything that appears poised for quick growth. A well-known example is the astronomical valuations of tech companies compared to other industries. For instance, at one point, people valued an operating system company like Red Hat Linux at more than 1,000 times the annual earnings, while a much different company and profitable shoe company with greater income was priced at just 7 times its earnings. This demonstrates how market sentiment can overshadow logic. There is little available science to confidently determine what people will speculate on next. While this may cause spikes in value for short terms, long-term investments over years tend to outlive these trends, and the underlying factors of value mostly prevail. That is why they say, in the short term, the market is a popularity machine. In the long term, it is a weighing machine. While we cannot control the market or its trend-chasing participants, we can control how we choose to interact with it. One critical factor for shaping your investment strategy is risk tolerance. Risk tolerance is often mistakenly thought to be tied to age, but it is deeply personal and depends on your specific needs and goals at any point of your life. By aligning your behavior with your realistic goals and unique risk tolerance, you can navigate the market more effectively and avoid the pitfalls of chasing trends or unrealistic expectations. When deciding what to invest in, it's important to be aware of whose advice you take. Speculation, not investing, is often dressed up as a sound advice by the news and Wall Street publications. But speculation is primarily benefiting the brokers, not the investors. Wall Street benefits when you choose to speculate instead of investing. Speculating tends to be more short-term, riding trends and looking for quick wins. And because every trade generates commissions for Wall Street and brokers, they earn a lot more when you speculate versus when you follow a more common path of true investing and focus on building long-term wealth, you end up generating fewer trades. This leaves more profits for you, however, it doesn't benefit the financial industry in the same way. A classic example of this speculative advice is when influential figures or publications suggest certain stocks are poised for growth. This creates a feedback loop. Day traders and everyday investors pile into the hype, artificially driving the price up themselves. However, this approach can quickly lead to losses, as the stocks often become overvalued, unsustainable, and many people begin to sell, which reduces the price. Initial public offerings are another way where Wall Street's advice often aligns with their own interests rather than yours. IPOs are when stock shares are born and sold onto the public market for the first time. They are marketed as exciting opportunities, though they frequently favor insiders and institutional investors. These groups get access to shares at lower prices before they hit the wider market. By the time the public can even buy in, the price has already been inflated. The modified term insider's private opportunity accurately captures this imbalance. In most cases, IPOs are less advantageous for the average investor than they might appear. Wall Street's advice should also be approached with skepticism, in addition, because there are no formal requirements for becoming a security analyst. As a result, recommendations can vary widely in quality. If you skip the advice and do your own research, you may still be at risk for misinformation. A business's own accounting practices can work to obscure a company's true financial health. Regular reports may include things like special charges, which are often vaguely defined, or anticipated losses, which can be recorded early and deliver this rosy impression of future profitability. Operating losses can be carried forward for up to 20 years, which further complicates trying to understand the true picture of a company's financial fitness. Finally, it's important to consider how inflation can affect your investments. Governments with significant debt tend to benefit from inflation because it reduces the real value of their obligations. For example, if a loan for $100 is used to purchase a television, and then inflation occurs, causing the TV to later cost $1,000, while a chocolate bar now costs $100, paying off that loan represents a much smaller portion of the overall value of the currency. Debt doesn't adjust for inflation, and this principle can have broad implications for markets and policies. Hopefully, through avoiding speculative habits, being careful with the advice you listen to, and being aware of the biases companies and governments may have, you will hopefully avoid being led to your own defeat. Over time, things change, and previous truths may become history. One notable shift is that stocks are no longer a reliable hedge against inflation. Previously, stocks often trended higher during inflationary periods. However, this has not been consistent in recent decades. One piece of advice often debated in investing circles comes from Andrew Carnegie, who most famously suggested focusing your resources and putting all your eggs in one basket. Just because the richest person in the casino won their wealth through risking their home's property does not mean you will also become rich if you do the same. Correlation does not equal causation. Putting all your eggs in one basket is a huge risk. While large fortunes have occasionally been built this way, small fortunes and most long-running wealth are rarely created and sustained through bets like this. Diversifying your bets, or putting some eggs in many baskets, remains a cornerstone of wealth preservation. I ask myself, is there anything I could put my money into that is guaranteed to grow forever and surpass inflation? The answer is no. If an investment could reliably deliver above-market annual growth indefinitely, its theoretical value would approach infinity. Everyone would want the security that comes with this investment, and people would be willing to outbid anyone to secure it. Similarly, misconceptions about stock splits reflect misunderstandings of how value even works. Some investors believe that a 2-to-1 stock split benefits the shareholders, but this is just an illusion. Splitting a stock does not change its intrinsic value, just as trading a dime for 2 nickels does not make you more rich. It merely adjusts the number of shares while leaving the overall value unchanged. On the other side of the spectrum, short selling, a bet that a stock's price will fall, can be equally misguided. A stock appearing too high does not guarantee it will drop, just as flipping a coin and getting tails 9 times in a row does not mean heads is due next. This is called the gambler's fallacy, and it often leads to people misjudging the market, as market momentum can defy expectations for a lot longer than people might anticipate. Together, these insights highlight the complexities of investing, whether it's recognizing the limits of stocks and inflation hedges, resisting the allure of concentrated bets, or avoiding common fallacies about growth, splits, and short selling. Successful investing requires a clear understanding of value, risk, and market dynamics. The stock market is a zero-sum game. Its movements are constant, but for every dollar gained, another one is lost. For one investor to win, someone else must lose. This fundamental truth shapes the market's competitive nature and reinforces the idea that there is no universal formula for success. As the saying goes, no truthful book can tell you how to beat the market. If such a book did exist, everyone would follow its guidance, but without losers, there can be no winners. So the market's balance depends on this dynamic, making it impossible for everyone to succeed simultaneously. If stocks moved in predictable cycles, wealth would be easy to attain. However, the market thrives on uncertainty and complexity, which makes investing a challenge rather than a guarantee. Even more challenging is the risk of deception. As musician Bo Diddley remarked, you can get ripped off easier by a dude with a pen than you can by a dude with a gun. This reminder underscores the importance of vigilance in financial matters. Contracts, advice, and investments can be manipulated in ways that cost unsuspecting individuals dearly. Understanding the nature of stocks is also critical to navigate the market wisely. There is no such thing as a universally good stock. There are only good stock prices, which fluctuate with time and circumstance. A stock may appear attractive at one price, but overpriced at another. Recognizing these nuances is key to avoiding overpaying for potential growth or undervaluing opportunities. As a stockholder, it's important to remember your role in the companies you invest in. By owning shares, you essentially own a portion of the company, including its cash and assets. The managers and executives are employed to work on your behalf, and if they underperform, it's within your rights as a shareholder to demand better leadership, or even to advocate for their replacement. Effective investors not only choose the right stocks, but also remain engaged and informed about the companies that they own. Investing wisely requires discipline. One of the simplest pieces of advice is to buy low and sell high, to purchase from pessimists when prices are low, and sell to optimists when enthusiasm drives them higher. As the Rothschilds famously summarized, buy cheap and sell dear. This strategy is most effective when paired with a focus on industries you are confident might grow. When selecting investments, it's important to limit your purchases to companies trading not far above their tangible asset value. This ensures that you're paying for real, measurable worth rather than speculative potential. It's equally important to maintain independence in your judgment. Avoid letting the crowd's opinions sway your decisions, as the herd mentality often leads to overpriced or risky investments. A critical rule for any investor is to separate speculative operations from true investment activities. Speculation is not investment. Mixing the two can cloud your judgment and lead to unnecessary risks. As G.K. Chesterton wisely said, "Blessed is he who expecteth nothing, for he shall enjoy everything." This mindset is particularly suited to the defensive investor, whose goal should be simplicity and peace of mind. For these investors, index funds that cover all major industries can provide steady returns without requiring constant oversight. In this approach, when asked about your portfolio, you may feel able to say, "I don't know and I don't care," when you are in a position to let your investments mature on their own time over a long period of time. Preferred stocks, despite their name, are generally not recommended for most investors. Similarly, new issues such as IPOs should be approached with caution or ignored altogether. Wall Street brokers often earn double the commission on these new kinds of stocks compared to established ones, incentivizing them to push these issues, especially when the market conditions are favorable. Finally, while it is essential to monitor your portfolio, balance is key. Give your investments a regular, critical review, but avoid obsessing over every daily fluctuation. Watching the market like a hawk can lead to emotional delusions, whereas a more measured approach fosters long-term success. By adhering to these principles, you can build a robust investment strategy rooted in discipline and foresight. The Intelligent Investor, Graham and the commentator outline a variety of strategies and principles for navigating the market, particularly for those who identify as defensive investors. A defensive investor's portfolio, according to the book, should maintain a balanced allocation of at least 25% in bonds and 25% in stocks, with neither category ever exceeding 75% of the total value. This balance is designed to protect against extreme market shifts while allowing for moderate growth. For those tempted by speculation, up to 10% of one's portfolio can be set aside in a speculative, otherwise named mad money fund, distinct from real investments. This is meant to satisfy emotional cravings for risk-taking without jeopardizing the long-term growth of your other investments. A well-rounded portfolio may also include a small allocation to precious metals, capped at about 2% of the total portfolio. This percentage can rise to 5% for individuals over 65, focusing on mutual funds that invest in metal companies. Similarly, bond investment should be high-grade and may include up to 10% in emerging market funds, with a preference for those with expenses below 1.25%. Foreign mutual funds, meanwhile, can make up a quarter of the stock portion of the portfolio. Dollar cost averaging, which is consistently adding a fixed amount to your investments, should be employed to reduce the impact of market volatility. This means you will buy more of a stock when its price is very low and less of a stock when it is very high if you consistently add the same amount of money to your portfolio, say $100 a week, for example. To ensure balance, portfolios should be reviewed and rebalanced maybe every 6 months, ideally on memorable dates like New Year's Day or the 4th of July. While the market cannot be controlled, defensive investors can manage factors like brokerage costs, ownership expenses, taxes, and diversification. Expenses should stay within specific thresholds. For example, 0.75% for taxable municipal bonds, 1% for large U.S. stocks or high-yield junk bonds, and 1.5% for foreign exchanges. Taxes should also be carefully monitored, particularly the impact of capital gains over time. Sometimes holding your stock for another year or another 5 years may reduce your tax liability. Furthermore, proxy statements should always be read thoroughly before and after buying stocks, as voting in proxies is key to being responsible as a shareholder. It's also advised to avoid granting managers over 3% of company shares as options. For most individuals, managing a stock portfolio independently is not recommended. Instead, index funds or low-cost mutual funds offer diversification and reduced risk. However, if an investor insists on picking individual stocks, they should focus on well-known, conservatively financed companies with a history of at least 10 years of dividend payments and a 7-year average price-to-earnings ratio of 25 or below. When evaluating companies, factors like long-term prospects, management quality, consistent dividends, and financial strength should be considered. Management track record, competitive advantages, and the use of EBITDA versus net income tend to be indicators of whether the company is focusing on sustainable growth or short-term profits. Additionally, financial strength can be calculated using net income, amortization, depreciation, adjustments for stock option grants, and non-recurring charges. Taxable bonds, according to the book, should only be held in tax-advantaged accounts like 401ks, while municipal tax-free bonds are better suited for non-retirement accounts. Investors should also be wary of new issues such as IPOs, which are often marketed aggressively by brokers to their higher commission rates. When selecting mutual funds, always review the fund's prospectus, focusing on its worst performing quarter to assess whether you can tolerate such losses in the future. The decision to sell should be prompted by significant changes in a fund's strategy, rising expenses, or increased volatility and was once a conservative option. Measuring investment success requires factoring in inflation. For example, a 2% raise in a year with 4% inflation might feel better than no raise at all and 2% inflation, but in real terms, it may be the same thing, even though it feels different. Similarly, stockholders should be cautious of companies with persistently low stock prices, as they are more prone to bankruptcy. Ultimately, it's a crucial thing to recognize that even the best analysis will occasionally be wrong. Markets are unpredictable, and luck plays a role in any investment outcome. Whether money is stored in a mattress or invested in a mattress company, prices will fluctuate daily. This timeless advice distills decades of experience into practical principles that help investors navigate the chaos of the market. While the future is uncertain, history shows that disciplined decisions like diversifying investments, monitoring costs, and minimizing risks often lead to favorable outcomes. Though no one can perfectly time the market, we can work to tame ourselves and adopt strategies that build and preserve wealth over the long term.